In this video, we are going to continue with the example of the statement of cash flows. We just finished the current assets section of the comparative balance sheets, and we're going to continue now with the current liabilities section. If you've forgotten the example, pause the video, read the question, and then continue the video again. Let's go look at the instructions again. Again, these instructions and the question are in Canvas modules as well as in the YouTube link, so you can download and rework this example. We just completed step 5, so let's move on to step 6. Step 6 says, from the comparative balance sheets, calculate the change in each current liability item. So just like we did for current assets, we're going to look at the change only in the current liabilities. Only current assets and current liabilities are tied to the statement of cash flows operating activities section. Once we find the change, if the change is an increase, we're going to increase the cash flows. So we're going to add that amount. If the change is a decrease, we're going to decrease that amount in operating activities section. So we're going to subtract that amount. So think of current liabilities and cash flows as having a direct relationship. If you really remember these two items in red, that'll kind of help you when you're preparing your statement of cash flows without constantly having to refer to notes. Here's your balance sheet and here's the liabilities section. Let's look at all the liabilities they have. Accounts payable, salaries payable, interest payable, and taxes payable are current liabilities. These are liabilities that the company will have to pay within the upcoming year, 1 year or less. Notes payable, bonds payable are considered long-term liabilities, so they do not belong in the operating activities section of the statement of cash flows. Just like we did for current assets, to look for the change, we're going to look at the difference between last year and this year. So what happened to accounts payable? Accounts payable decreased by how much? It decreased by $2,500. Think of current liabilities as having a direct relationship with operating cash flows, which would mean that if accounts payable decreased by $2,500, we are going to decrease cash flows by $2,500. As you get more and more into accounting, you'll understand why a decrease in liabilities or current liabilities translates to a decrease in cash flows. But at this stage, just learn how to prepare the statement and then you can evaluate why later. Let's look at the next one, salaries payable. What happened to salaries payable? Salaries payable also decreased. By how much? $900. So the decrease in salaries payable will also cause operating cash flows to decrease by $900. Now let's look at interest payable. What happened to interest payable? Interest payable increased. How much did it increase by? It's $1,500. So to calculate that, you take your $2,300 minus $800. That gives you $1,500. Because there's a direct relationship, this increase of $1,500 also causes operating cash flows to increase by $1,500. The last current asset is taxes payable. How did that change? The change is also an increase, and it's an increase of $1,400. That increase of $1,400 will cause operating cash flows also to increase by $8,400. That is the last item of current liabilities. Notes payable is a long-term liability. Let's go back to the instruction sheet. Step 7 says add the amounts from step 1 through 6. This is the company's operating cash flows. Steps 1 through 6 is basically all these items. I did indent all the adjustments, so what I'm going to do is I'm going to extend this out and total all the adjustments in the same column as net income. The next step is to total net income and the sum of all the adjustments. We call this net cash provided by operating activities. The reason we call it provided is that you're going to find that the total of these two is a positive number. If it was a negative number, you're going to call it net cash used by operating activities. But in this case, it is a positive number, so we're going to say net cash provided by operating activities. The next section we're going to work on is cash flows from investing activities. Investing activities have everything to do with long-term assets. So we're going to be looking at the balance sheet and looking at the long-term assets, which is land, equipment, furniture, and of course accumulated depreciation that's related to the long-term assets. For investing activities and financing activities, we're going to refer to this additional information provided at the end of the question. At this stage when you're learning, most of this information is provided here. As you keep advancing in your accounting classes and you get more and more difficult questions, sometimes you will have to analyze the accounts and look for the change in the accounts. Let's look at the additional information. So our first item is land. Land, we see that something changed with land. They had land of 15,000 and now they don't have any more land. So we know something happened. Let's see what they say. It says land was sold during the year for $20,000. So if land was sold during the year for $20,000, we know that the company would have received $20,000 cash. That cash that they received belongs in the investing activities section. So we say sale of land, and we put the 20,000 as a positive number because money is coming into the company. It's an inflow of cash. We're done with land. Let's look at equipment. Did anything happen to equipment? Yes, there is a change between last year and this year. Let's look at the additional information to see if they provided anything. So we just did A. B talks about furniture. Here we go. C says the company sold equipment with a cost of $15,300 and accumulated depreciation of $2,000 for $10,300. So now we got to figure out, we got to analyze the statement and figure out what are they telling us. They said the company sold equipment with a cost of $15,300. Well, the cost is not cash coming in, so we don't need to worry about the cost. Then they told us that there was accumulated depreciation of $2,000 on that equipment that was sold. Again, nothing to do with cash, so we don't take that $2,000 into account. Then they say that the equipment was sold for $10,300. That is the amount of cash that the company received for selling this equipment, and that is what belongs in the statement of cash flows in the investing activities section. We're going to say sale of equipment, and it's money coming in, so we're going to say $10,300 and put that as a positive number. Let's go back to the balance sheet. So we took care of land, we took care of equipment. Now there's furniture and accumulated depreciation. We don't need to worry about accumulated depreciation because, again, accumulated depreciation is a non-cash item. At this point, you don't need to worry about it. But furniture, if there was a change, we do need to worry about it. So was there a change? Yes. It looks like furniture increased. But there is a note here. It says the company purchased $1,500 of furniture. So whenever a company purchases long-term assets, that's an investing activity. And since the company purchased, it's money going out of the company. We're going to say purchase furniture, and that will be negative $1,500 to show that $1,500 is an outflow. We've reached the end of the assets, and therefore that is the end of cash flows from investing activities. Now all we need to do is total these three items, and that would be the net cash. Again, I'm going to say provided because we had more money coming in than going out. Therefore, it's net cash provided by investing activities. Let's total those numbers. And we find that 28,800 is the net cash provided by investing activities. The third section is financing activities, but I will be doing that in the next video.